Assalamu alaikum warahmatullahi wabarakatuh. Name, Intan Safatri. Class, AKT 23A. NPM, 234120047. Intercompany ownership reporting is a fundamental aspect of consolidated financial reporting, particularly in corporate groups where a parent company owns shares in one or more subsidiaries. In today's global business environment, many companies expand their operations through acquisitions, partnerships, or by establishing subsidiaries in various sectors and countries. When this occurs, it is essential to prepare consolidated financial statements that present the financial position and performance of the entire group as if it were a single economic entity. This ensures that internal transactions between the parent and its subsidiaries, or between subsidiaries themselves, do not distort the overall financial picture. The foundation of intercompany reporting lies in the proper identification of ownership relationships. When a parent company holds more than 50% of another company's voting shares, it is presumed to have control, and full consolidation is required. This means that the financial statements of the subsidiary are combined line by line with those of the parent, including all assets, liabilities, revenues, and expenses. However, any intercompany transactions, such as internal sales, loans, dividends, or service fees, must be eliminated during the consolidation process. For example, if the parent sells goods to the subsidiary, both the sale and the corresponding purchase must be removed from the consolidated revenue and cost of goods sold to avoid inflating the group's performance. In cases where the parent company owns between 20% and 50% of the voting shares, it is considered to have significant influence over the investee, and the equity method is used. Under this method, the investment is recorded at cost and subsequently adjusted for the investor's share of the investee's net income or loss. Dividends received reduce the carrying amount of the investment. This approach reflects the economic reality that the investor does not control the investee but can influence its decisions. If ownership is below 20% and there is no significant influence, the investment is reported using the cost method or fair value method, depending on applicable accounting standards. Another key aspect of intercompany ownership reporting is dealing with non-controlling interests, minority interests. These arise when the parent does not own 100% of the subsidiary. The portion of net assets and net income attributable to the minority shareholders must be clearly presented in the consolidated financial statements. This ensures transparency and fairness for all stakeholders. Additionally, challenges often arise when subsidiaries operate in different countries, leading to differences in accounting policies, fiscal periods, and currencies. Therefore, standardizing policies and converting foreign currency financial statements into the reporting currency of the parent company